Are you working until 65 just because everyone else is doing it? Imagine waking up at 65 with a chronic backache, and you finally have the permission to retire. But your body's now too fragile to travel around the world you spent 40 years dreaming about. Now imagine retiring in your 30s or 40s because your investments pay for your life. You're traveling the world and pursuing your passions today simply because you solved the math of freedom while your peers are still stuck in the corporate rut. In this video, we extracted 3 concepts from the book Quit Like a Millionaire to help you stop trading your time for money. This simple system allowed the authors to retire at just 31 years old, decades earlier than their peers. We're going to show you how to find your freedom number and build a system that pays you to live. If you feel like you are wasting your best years just to survive, this knowledge is your exit strategy. Now it's time to stop being a good employee and start becoming the owner of your own life. Concept 1, the 4% rule, finding your freedom number. The biggest question in personal finance is, how much money do I actually need to stop working? Most people guess a random, scary number like $5 million. But the 4% rule gives you a concrete target. Financial experts found that once your portfolio reaches a specific size, your freedom number, you can safely withdraw 4% of that total every year to live on, and your money will likely never run out. Think of your investment portfolio as a fruit tree. The tree is your principal, or the initial sum of money, and the fruit it grows is the interest. The 4% rule says that once the tree is big enough, you can live entirely off the fruit that falls. As long as you never chop down the trunk, the tree will keep feeding you for the rest of your life. To turn this theory into reality, you need to follow 2 simple steps. Step 1, identify your annual burn rate. Look at your bank statements from the last year to find the total of everything you spent. This is the foundation of your entire plan. Step 2, find your freedom number. Take that annual spending and multiply it by 25. If you spend $42,000 a year, your target is $1,050,000. Once you hit that number, you are officially work optional. Concept 2, the cash cushion, your market insurance. The biggest fear in early retirement is a stock market crash right after you quit. This is sequence of return risk. If the market drops 30%, your freedom number of $1 million might suddenly look like $700,000. Most beginners think they should just keep withdrawing 4% by selling stocks even during a crash. Don't do that. Selling your stocks when they are at rock bottom prices is like chopping down your fruit tree during a drought just to get a snack. It ruins your portfolio's ability to grow back. Step 3, establishing a cash cushion. Accumulate 1 to 2 years of living expenses in a high-yield savings account. When the market crashes, you stop withdrawing from your investment portfolio entirely. You freeze your accounts and live off this cash for 2 years. This gives the market time to recover while your money tree stays untouched and healthy. Concept 3, the yield shield, your defensive pivot. To make your retirement even safer, you need to change how your portfolio behaves as you get closer to your retirement date. Phase 1, the growth phase. While you are young and working, you focus on growth stocks or total market index funds. You want the tree to grow as big as possible, as fast as possible. Phase 2, the yield shield. As you get within 2 to 5 years of retirement, you activate the shield. You start shifting a portion of your portfolio into income-producing assets like dividend, ETFs, or REITs. Step 4, establishing a yield shield. Instead of selling shares to get cash, you let the companies pay you directly. If your $1 million portfolio yields 3.5% in dividends, you get $35,000 a year in automatic income. During a market crash, companies often continue to pay dividends, even if their stock price is down. You live off those dividends first, then use your cash cushion to cover whatever is left. Between the dividends and the cash cushion, you can survive a multi-year recession without ever being forced to sell a single share of stock at a loss. The takeaway of Quit Like a Millionaire is simple. Financial independence isn't about being a genius. It's about realizing that money equals time. By applying the 4% rule and building your cushion and yield shields, you stop trading your life energy for a cubicle. We've all been told that working until 65 is the safe path, But is it safe to gamble your best years on a plan you didn't choose? The cage door is already unlocked. The only question left is, will you stay inside just because everyone else is? Retirement is a number, not age.